The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen, and thank you for being with me today. Good morning to our friends down under and across the ditch. How's the volume, folks? Can someone let me know if you can hear me okay? Just type in the question box. Who have we got? Yep. Good. Dean, you're the fastest as usual. Good to hear, mate. Good to hear. We probably need to have a talk about how you're shorting grains. Is it going okay? Have you got yourself up to it? You let me know, won't you? Look forward to it. Okay. Can you hear all right, Dean? Yep. Hello. Can you hear me? 1, 2, 3. 1, 2, 3. Oh, you can hear me well. Good. Thank you, Dean. That's grand. Okay, guys. So, boy, exciting times, isn't it? Markets are really rewarding us as they should. And we've got Rolf with us. Hello, Rolf. Yeah, lockdown capital of the world in Melbourne, Australia, Victoria. That's a southern state. Yeah, they're having a bad time, and so is New South Wales. And I guess it'll come to us soon. This new Delta variant seems to be very, very much more contagious, and it's really causing some issues. Okay, so let's see what we've got here. Lots of people with us today. Good to have you, Al, Albert, of course. Alex S. Sharuba, haven't seen you a long time, mate. Glad to have you with us. Anthony down in Sydney there. Colin. Daryl, gosh, I haven't heard from you for ages and ages, mate. He's a tutorial guy and lovely fellow. Dean, of course, George, James, Jim, that is, that's Jim C. Good to have you with us, Jim. Jeff, of course, Joel Goldman in Vero Beach, gotcha. Keith, of course, Marcel, my friend up in Canada. It must be one of my longest serving clients. Gosh, and he's done tutorials and all. Marcel, what a delight to have you today. I hope you're well. I hope your health is good. Take care, my friend. Mark, of course, can't do anything without him. He's a long-time Daniel Code member, and here we are. And a tutorial guy as well. Let's see where we are. We're all over the place at the moment. Oh, Peter, he's our short-term guru, of course. Dean, we've said hello to. Toddy over in California. Colin, Rolf, of course, we've mentioned him. Teresa, lovely to have you with us. We don't have many lady traders for some reason that's beyond me. Interesting, isn't it? In Japan, women are really into all Japanese are really into Forex. It's huge in Japan, but women provide the majority of traders and very good at it too. George, of course, glad to have you with us. Scott, Jeff, we've done these. Yeah. Brandon, good to have you with us, of course. Stephen, yes. Michael, up to the dentist from Michael M., the dentist from Chicago. Grand to have you with us. Gosh, you've been with us a long time too. Norbert, of course, he's a tutorial guy. Good to have you with us. Rob, of course, and Akshay. Also been with us a long time. Okay, folks, so let's get started and get see what we've got for you today. And we're going to have some reasonable comments about time as we go on. It's all getting very neat and nice, and well, it's not nasty yet, but we hope it will be. Okay, rational, the markets are rational, orderly, and sometimes predictable. These are your priorities for trading here. And this is a slide from 2 weeks ago, which is a fortnight. I know it's not an expression used much in America, fortnight, but it means 2 weeks or 14 nights. So we use it a lot down here. So these are just to refresh your memory. Risk management, such a big thing. And you should be able to tell the probable trend from just a single daily bar. And we do that all the time with, an 85 to 92% efficiency rate. If you can tell the trend with a high probability from just a 1 a bar, you're well ahead of the game. Okay, so let's have a look what we've got here. So let's take a rocket to space. We're going to look at these celestial bodies. We're going to look at some other things as well. Deborah's with us now. Thank you, Deborah, for being with us. We love having ladies with us. We need more of them. I hope you're enjoying this, Deborah. So here's our rocket shot out in space. And, of course, you know, your basic preschool learning. The moon rotates around the Earth, and the Earth and the moon both rotate around the sun. So we've got sun cycles, moon cycles, all sorts of things. So both the sun and the moon create gravitational pull on the Earth. And of course, the sun is many, many times stronger, but it's also much, much farther away, which diminishes some of that gravitational pull. You can see that these celestial bodies are very real. They're working all the time, and they do have an effect on what markets do. They do often provide us turning points in markets. So remember, the Earth is spinning on its own axis, but it's at an angle. So it appears as if the sun goes up and down through winter and summer, but of course the sun's not moving, we are, and because the Earth has got an angle through its axis, as it moves around, the actual direct or nearest line moves from the Tropic of Capricorn, which is down here, to the Tropic of Cancer, which is up where the vast majority of you folks are, and it crosses the equator twice in each cycle. And it does create subtle changes. Apart from the weather, it creates changes in markets, and it gives us interesting areas of support and resistance. So you can see how this works with the direct angle is the horizontal plane, called the plane of the ecliptic. You don't need to know the jargon for these things, and you can see the angle there, which is causing these movements when we start looking at really long-term charts. We're looking at movements as it moves to the Tropic of Capricorn, then crosses the equator and goes to the Tropic of Cancer, and then it reverses and does the same thing. The Tropic of Capricorn is reached in December. It's called the December solstice, and the Tropic of Cancer is reached in June of each year, and it's called the June solstice. So as well as that, we've got these tidal ranges running with tides, and you can see this is actually a shot taken from West Australia, and this is the tidal flow. This is actually called the tidal race. It's real. The power of the tide, we don't see it. Most of us don't live close enough to the water to see it. But if you can, I mean, it's so gentle and imperceptible, but you will notice it rises and falls, some places pretty dramatically. Up on the north coast of Queensland, where I am, but much further north from here, tides rise and fall about 26 feet through each tide. I mean, it's quite extraordinary. That's affected, of course, by the topography and the shape of the Earth right there. But what's happening is that a very important part of looking at time in your trading is Apogees and Perigees. And what happens there is that the moon is on an elliptical orbit around the sun, and at certain times, which we call perigees, it comes as close to the Earth as it will on its cycle, and at other times, which we call apogees, it's as far away from the Earth as it's going to get on its cycle. These things, if you have a look at how they work, here we are. If you look at the top picture here, you can see that the sun and the moon, both of which create gravitational pull on the Earth, are in the same plane. They're in line. So the gravitational pulls the moon exerts and the sun exerts, they're working together. And that is the time at perigee when you get the greatest level of gravitational pull. And that's why we get the super big tides then. They're called spring tides normally. But the opposite, if you look at the bottom, is when the moon in its cycle is on the opposite side to the sun. So you've got the sun's gravitational pull exerting on the Earth, as you can see, but on the other side, the moon's now across the other side of the Earth, its gravitational pull is working against the sun's gravitational pull. So that's when we get what we call neap tides, N-E-A-P. Very, very low, super low tides, springs and neaps. Very interesting, but it's real. It's totally real. If you can imagine in your mind the size of a tidal surge that's being dragged around the world by the moon, and that massive, massive amount of water that's involved, then go and fill up a couple of garden buckets with water, hold them out the side, get your arms straight, see how long you can hold them. That'll give you a real insight into how strong gravitational pull causing tides is. In fact, those of you who are interested in short-term trading, have a look at matching it to a tide chart. I used to do this all the time, and I actually had some surveyors, and I asked them to go and get me the exact measurement, hours, minutes, and seconds for the center of the New York Stock Exchange, because, of course, it's the trading of stocks that allow us to trade futures. The futures are a derivative. They're derived from the net price of all of the stocks in each of those particular indices: Dow Index, S&P Index, Nasdaq, Russell, etc. And they weren't allowed in, so they didn't get that, but I did get the exact coordinates on the top of the steps leading into the New York Stock Exchange. And the closest tidal battery, which is what they call tidal measuring points there, is called New York Battery, and it's at the end of Wall Street, not far away. So I was timing the length of time it took the tide to get from the shore, that's New York Battery, because, of course, this tidal pull, you only see it in the oceans and the seas, but it's happening all the time. And when it hits shore, that tidal pull, that gravitational pull, is still acting. And it's what we call air tides, and it works as it moves across the face of the Earth. The same gravitational pull is being affected on land as it is on sea in the relative plane. So Benjamin, welcome. Rob from New Zealand, good to see you all with us, mate. And very, very smart guy, Rob. Okay, let's see what else we got here. I think we've got most of them. If you came in a bit late, I'm really glad to have you with us, so that's fine. Okay, Keith joined us, good on you. And George, of course, yes, most of these. And Toddy over in California. Todd, hope you're well. So there are all these forces working, and they're all natural forces. And they're working on us all the time. They're working on us, on our bodies. They're working in markets. They're causing a lot of these turning points. It's very subtle, all of this thing, these signals to do with natural phenomena that, Apogees, Perigees, lunar cycles, etc., a lot of which I've shown you. And they have marked effect. And if you want to be a serious analyst and calculate probable turning points in markets, that's the sort of stuff you need to know, and I'm more than happy to teach you that. You probably notice, or I hope you notice, that I use the word probably whenever I'm talking about turns and trends, because everything we do in trading is a probability. There are no certainties. It's like life. There are all sorts of probabilities in life, as there are in trading, and some of those probabilities get to a very, very high percentage, but they're still probabilities. We do not have foreknowledge. We can only see the river of our life from behind, the way it's run, until this moment. we can't see the river of our life ahead. Only God can see the river both ways. So we do not have any foreknowledge. And what you see me doing with these charts, what you see Frank doing with the fourth seal, is we're taking things that the markets have done historically, and we're identifying the highest probabilities, and that's what we're talking to you about. So these are the pullbacks. I've just gone through them to show you some of the major ones, because if you're interested in this stuff, you should pull that up and have a look at it. And see how the different patterns, the different topping patterns are created. It's very, very interesting. This is one of the tools you should be looking at. This is at random. This is mid-2015. And what the little blue letters are on there are Apogees and Perigees. And you'll see that sometimes they're quite close together and sometimes they're quite far apart. They change. That cycle's changing all the time. But really, really simply, running off a swing high on the left of your chart, the 44 cycle, that's the one of the Daniel Code cycles. That's actually the cycle for gold. It hit the little high on the 44 cycle perfectly. Then it moved on. It actually gave us the chart high on the 59, and we then took the same setting and ran it across from the 62 or the 59. I think it's the 59. It should show us a bit more clearly than it does, but in any event, that gave us the next top right on an apogee, and it gave us the what was for then the major low, 1 bar before the 70 cycle. So even though this is a daily chart, the variance is the same. All of these time cycles are valid to plus or minus 1 period, and that's because they can start at different points. For example, you could have your time count starting from a swing high or a closing high, and they can be different. In the same way, your lows can start the count from the swing low or the closing low, and that's important. But you can only go back 1 bar normally to see if that difference is there. So when you're thinking about this, differentiate between swing highs, swing lows, and closing highs and closing lows. So you can see on this particular chart, we've started running Daniel Code time cycles from the low in December and 08. This is still running through this chart at random. And you can see that 29 gave you the swing high, but it was the swing low to the closing low was the next cycle. This cycle happens to be the swing low to the closing low plus or minus 1 period. The actual highest closing low comes on the next period. So we've then gone to that closing high there, which is also the swing high, and now it's switched its cycle. It's gone from high to closing low, and the dominant cycle before that, which finishes up terminating at the same place, the 44 and the 74 time cycles are both fractals of the Daniel Code, and that's why you get 2 numbers right on top of each other, because one is a fractal of the other. And the same when you're looking at price in markets. You'll often see the Daniel Code numbers, the price numbers, one on top or very, very close to another. And that happens all the time. It doesn't mean it's a stronger signal. What it means is that all markets are fractals. All market moves are fractals of previous moves, without exception. So you can see that here. You finish up with 2 entirely different cycles. One's 44, which is the cycle for gold. The other one's 74, and they give you the closing low. You see the bar before that, immediately before that, is the chart low, as they would call it. That's, in other words, that's got the lowest low on the chart. But the next bar is the closing low, and that can make a big difference. So keep thinking about that. And this is the S&P, and essentially I'm showing you the same thing. We're back in 69.70 here, and I'm showing you how these tops come in. And the first low down on the 62 cycle, that came from a closing high to a swing low, which was also a closing low. The next cycle up, the 89 cycle, that was a swing high. It's a swing high because it's got a lower bar either side of it. The 103 cycle, which is an extension of the down code range, is one bar off the swing high and closing high of that move. And the 118, which of course is twice 59, that gave you the chart high, the swing high, but the bar before it was the closing high. So that's why we have allowed variances of plus or minus one period, because of the mechanics of how it works. So we're very focused on the S&P at the moment. And essentially what's happening in markets is they appear to be running out of puff. And when they want to goose the S&P, they'll do it, they being the PPI, the Plunge Protection Team, which is real. They will goose either the Nasdaq or they'll goose the Dow, both of which have an effect on the S&P in terms of sentiment and what have you. So have a look at this, and what I'm doing here is I'm focusing on the flash crash we had back in February 2020. It doesn't look much on this chart, but was very dynamic at the time. We had time cycles at the high, we had blue line sell signals at the high, and we actually got short the day of the high. And in 3 trades, we made about 24,000 per one S&P E-mini contract. It was dramatic, and it also gave us the shortest bear market in history. A bear market is generally defined as a drop of 20%, triggers the calls it's a bear market. This market got down to 20% in the S&P. Now, it doesn't look dramatic, but it's vital. It's a terribly, terribly important part of the present chart structure, because that dramatic fallback, even more dramatic in the S&P, is defining what's happening now at the highs of these cycles, which we think are perilously close to ending. But what you should notice on this chart, we simply run a standard Daniel code time cycle from the blue line on the left of your chart, which is the closing low of that swing. It's not actually the closing low of that chart. The bar 3 bars before is the closing low, the closing high, I should say. I think it's also the swing high. But we've taken the closing high closest to the start of a pullback. And you can see it's defined this market pretty nicely. 29 cycle, which is the base Daniel code number. 29 is time. 29.6 is time. And time and price are the same thing on different axes. Now, I know that's hard to accept, but we use exactly the same cycles for time as we use for price. If you want to know more, go to the Daniel Code website and have a look at the chart archives. There's over 44,000 charts in there that I've created with price cycles on them over the years. And you'll be really hard-pressed to find a market that's turned anywhere except at the Daniel Code numbers. It's really quite extraordinary. And honestly, no one's more amazed and thrilled by it than I am. I mean, it's absolutely total miracle stuff. There we are. So now we're looking at time on the horizontal axis. So we had a nice hit on the 29. The 44 came 1 bar after the low. These are 6-day bars we're working on now. The 50 gave us nothing. The 59 gave us the high and the start of the move down on the 6-day chart. And the low came at the 62. And it's that conjunction of 59 and 62 that keeps tugging at my mind. And you can see the rest of the cycles there. 70 gave us nothing. 74 was 1 bar off a minor high, 89 was 1 bar off a minor low. Those are the sort of ways these cycles work. But I keep thinking about this nexus between 59 and 62, how it's defined this flash crash so beautifully. And we're looking at Nasdaq because, as I say, the strength in the market is in the Nasdaq and sometimes the Dow. The weakness in the market is in the Russell 2000, which is the small caps market. And for those of you who've been struggling with the S&P, which is getting pushed around a bit lately, then have a look at trading the Russell 2000. I've been trading it for years, and it's a very, very good market. One of the reasons it is such a good market is it gets the least commentary. In other words, it's this commentary and CNBC and Bloomberg and 100 other websites that excites the day traders, and that's why things get pushed around a bit, as has happened to the S&P on this last sell signal. But if you have a look at the strength in the Nasdaq, it's extraordinary. It's actually acting a bit like a commodity. I think we're into a blow-off top, which you see in commodities quite often. You don't usually see it in equities, but we need to be thinking about the Nasdaq because that's what's driving this current rally. And a little bit of weakness today, but not a lot. But look at how these cycles keep marching along. Now, I put this chart up to show you about Apogees and Perigees. I know it's a mouthful, but look how the Apogees and Perigees track markets. We start this off at a perigee. Bear in mind this is plus or minus 1 day, because if these days appear actually on a weekend, if the actual perigee or the apogee happens on a weekend, it's going to get posted as either being on Monday or Friday, because equities don't trade, hardly any CME type markets trade over the weekend, although, you know, Bitcoin and Ether, Ethereum, they do trade over the weekend, but we're not trading them. So the sheer geographic fact of the cycle falling on a weekend means it's going to be pushed either the Friday or the Monday by the charting program. So that's one of the biggest sources of that variance. So anyway, I've started just here straight off a perigee. You can see the 29 cycles come in 1 day after the apogee. As we move along, the 59 cycle stopped on a perigee. The 62 cycle gave us the high of that move. As we move along, the 103 and the 118, which are all extensions of the Daniel Code time ratios, gave you a little tiny swing high at the apogee before the chart high, which came right at 118 days, which is twice 59.3. That's how time works, time times and half. And it's right exactly on the high of the Nasdaq. So it's a very, very good trading medium, the Nasdaq, and it's very, very responsive to time cycles if you know how to do them. Have a look at the low. We went from perigee. First half cycle was the 14. It was 1 bar from the low. This is the flash crash we're looking at around February 2020, February 19th, 20th. And then the 29 gave us the low, exactly from the perigee, and 1 day before an apogee, which may or may not have been actually 1 day before, depending on where it fell on the weekend. Then the 62 gave you nothing really. It was 2 days before the high. And then the 74 gave you the gap up, trade down high near the end of the chart. But what you should be interested in is, if you remember how dramatic that flash crash was, market structures, traditional support and resistance, get absolutely blown away when market gets this level of volatility. And these were huge bars for those of you who remember. But interestingly enough, with the Daniel code, the more volatility there is, the more exact it gets. As you can see here, a simple basic Daniel code time cycle from the perigee near the high gave you the low. And that was certainly worth knowing, because very few other people knew it. And that was a great bit of trading. So what we're looking at now is the .com high. This is the 2000 .com high. And those of you who were trading then will remember that markets had managed to convince themselves, essentially, tech market, that the currency of markets was eyeballs. And these stocks were being bid up to ridiculous levels. No financials, no profits, just eyeballs, or clicks, as they used to call it. And if they got enough clicks, then the market went up. People said, "Wow, it's getting clicks, it's getting eyeballs. It must be worthwhile. It's a growth stock." Well, it was until it wasn't, like all of these things in markets. And March the 24th, 2000, that was the last day. Then it wasn't, and down it went. But look what happened. We've just taken the Daniel code time cycles straight from a closing high in a minus swing. That actually is actually a high before the high. There's a number of them. That's a point from which that's a high before the high. That's the point at which we would start a fourth seal angle. Highs before the highs, lows before the lows. But simply putting a standard DC time cycle on that, 29 gave us nothing, 44 gave us that high. 59 gave us the first part of the low. 62 gave us the rally back high. 70 gave us one bar past the rally back high. I mean, is it worth knowing this stuff? I love it. I use it all the time. And in fact, our TO3 and TO3 plus signals have a small element of time in them. And that, I suspect, is why they're so good. They really are sensational. So, excuse me. So this is the S&P at the 2000 top. And I want to show you some of the things that I think about that I'd like you to be aware of. So the swing high came in about March 2000. That wasn't the closing high. Look where the closing high was. I put a red box around both those relevant bars. These are 6-day bars, I should say. And this is the index, not the futures. But the closing high didn't come until August, September. And the first high came in March. In fact, April, May, June, July, August, September. 6 months between the swing high and the closing high. And it was the closing high which really started to give you some selling momentum. The swing high had 2 bars down, and then 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19 range trading bars, all trading inside that big outside bar that you can see under 2020. This is not 2020. This is 2000. This is 2000. Excuse me, my error. This is 6 months in 2000. This is the S&P high in 2000 when Nasdaq made the .com high there. So let's have a look what these Apogees tell us if we're going to move on a bit. This is Nasdaq. These are the basic time cycles. Running from Apogees to Perigees. We know that it likes those cycles, so I put them on the 6-day Nasdaq chart. You can see if we start from the Apogee, which also incidentally happened right at the high of the flash crash back in February 2020. Very, very important, as I said. So that happened right at an apogee. If we start our time cycle from there, at 29, the first of the Daniel code numbers, 29.6 is time. We got a swing low on the 6-day chart. Move on to 44, the time cycle for gold. We got the next swing low, plus or minus 1 period. Move on to the 50. It hit the perigee right at the high of the next little rally. So where are we sitting along these time cycles? Most of them have worked very, very well. What's not on this chart? 29, 44, 50, 59, 62, all of those ones are there, aren't they? Have a look. The 59 gives you this coming 6-day period, right about to start now, any time, any day now. So it hasn't been totally in sync with the S&P to date, but it's now going to be for the next 8 or 9 trading days. It's going to be in the prime cycle to make a top, if in fact we're going to get that turn that the fourth seal has been talking about now for over 18 months. Quite extraordinary, isn't it? Look what happens if we just change that a little bit. It's the same high. This is February 19th, 2020, but we've now going to use the closing high, which is 1 6-bar period. In each of these bars, it's got 6 trading days in it. We're now starting the count not from the highest high, right, the swing high that started the move down at the apogee. We've actually put the start of the wave of the wider count on the bar before where we have the starting apogee, which is actually the closing high of that move. Look what it's given us. 29, 1 period past a little rally high. 44 is now exactly on the low. 50 is now exactly on the high and 1 period before the perigee. So that puts the 59 cycle on the, which is a very dominant cycle. That puts the 59 cycle right on the current 6-day period. Now, even the 6-day periods, they're valid plus or minus 1 period. So we had last 6-day period. We're now in a new 6-day period, and that is actually the 59 cycle. And the next 6-day period is the 59 cycle plus 1. In other words, it's valid as well. And you can see that's where I get the red dot. And that's just to remind me that we, at this stage, expect to see a reaction to this time cycle. If not, you've seen how before that, at this flash crash, the 59 and the 62 molded that whole movement. 59 at the high, 62 at the low. Well, don't discount that we also get some price action at the 62 cycle, which is a few days off yet. This is a more detailed time chart of the Nasdaq, and you can see it all looks very, very nice. It gave us the 62 cycle starting from August 2018, finished up giving us a little 1 bar off the high at the 29, 1 bar off the high at the 44, nothing on the 50, nothing on the 59, and 62 gave us the start of the flash crash in February 2020. 70 gave us nothing, 74 gave us nothing, 89 gave us the high after the rally high of that move. Then we put on the same cycle starting from the 62. Look what we get. The 59 cycle is expiring, and that looks good if we start from the if I can show you, it's this start of this blue 62 cycle here on the way along. It runs along. It gives us a high at the 89. By then that's ended. So we start running it from the 62. We're now on this cycle, these time cycles that are running across here. You should be able to see the 29 gave us a swing low. The 44 gave us 1 bar past a swing low. The 50 gave us the high of that little rally. Now the 59 is right on the current cycle. It's just starting, as you can see. It looks to me like it's probably just started today. That's a 59 cycle, and the 62 cycle is a couple of weeks later. And I've got them both on the chart. I've had them there for years, at least a year. The 2000 flash crash really excited me, and I think it's got to be an important timing model for what comes next. It's too dramatic and too, excuse me, well encapsulated encapsulated by the two Daniel code numbers, 59 and 62. So I just reiterate, it's very important with everything to do with trading. We're talking about probabilities. Some of these probabilities get very high, but don't try to trade the 6-day, 12-day charts. You can't. Because the risk on entry is way outside anyone's reasonable time parameters, price parameters, anyone who trades the Daniel code anyway, you have to have a daily signal to pull you into the trade. So wait for the daily signal. That will not always be satisfactory. We had, I think, a blue line and a TO3 sell for yesterday on the S&P E-minis, and of course it got elected, then went up, did an outside bar, which got us long again, and today the sell started to bite. So that was a pretty messy little bit of trading, which is what can happen to everyone. But as I've been saying for years, if you're into equities at the moment, do have a look at the Russell 2000 because it gets the least coverage. It seems to be the easiest and simplest to trade in a straightforward manner. It certainly has been for this bit of trading that we're in now. Okay, let's see what else we have for you. So this is that flash crash. You see, I've got a crosshairs on it through my telescope. Just important. Just think about the high comes at the 59, the low comes at the 62. Remember, for almost everyone who wasn't a Daniel code trader, people were absolutely flummoxed at this sell at the top being elected and the speed it went down. And hardly anyone ever believed that low was going to hold. All the commentary was, oh, we'll get a small retest up and then that'll be it. We'll get a big wave 3 down, that sort of rubbish. But keep thinking about that. 59 at the high, 62 at the low. Can it be that accurate? Yeah, sometimes it is. The 44 worked nicely. The 29, I should say, gave us a swing low. The 44 1 bar off a low. 59 at the high, 62 at the low. 89 1 bar past a swing low. Can't do a whole lot better than that. Those cycles are just biting. And they're biting me too because I love it. Have a look what we've been doing in our trading lately, folks. This is crude oil. This was the TO3 signal day before yesterday. Nice little bit of trading. Don't forget that Frank also does a fourth seal commentary on crude oil and gold, and they're very, very good. They're just as good as the amazing stuff he's been pumping out for us on the S&P. This is the E-mini, and there's that nasty little move I told you. We got target recognition. These are daily bars, of course, on Tuesday, Thursday, Wednesday, and Monday. And that set up a TO3 and a blue line sell signal. Look what happened. The trade was elected on Wednesday, went down, hit the support at 43.50. That's been on your chart for since the high, and hit that exactly, turned around as if it was stopped. And how accurate are those retracements? Well, let me see what I can tell you. This is the S&P. Here it is. That low was 433.250. Where's the Daniel code number on that chart? 43320. 2 ticks variance, that's all. Exciting, isn't it? But the close looked reasonably strong, didn't it? Let's move on. Russell. I've been talking to you about the Russell. We traded that all the way up and all the way down in 2 legs. It had the TO3 sell signal. It made that little rally high at 2283.4. Gone past it. 2283.4. Where's the Daniel code line? 2282.5. 4 ticks. Extraordinary, isn't it? That's how accurate this stuff is. However, here's a warning. Have a look where this thing is closed. Right on the blue line. The blue line is at 2186.8. Today's close 2186.1, 7 ticks variance. That's target recognition, folks. In fact, that's target recognition on the blue line. Target recognition is valid at the bar, high, low, or the close. If the market's going down, as this one has been, we expect to see target recognition at either the low or the close. Both are valid. So there was that close right on the blue line. The short-term stochastic, this is the long-term stochastic, is oversold. The short-term stochastic is also oversold. There's divergence on our proprietary momentum indicator, and that set up a TO3 buy signal and a blue line buy signal for tomorrow. Okay, now bear in mind that Daniel code signals are all conditional. Once we create a signal, we don't have the hubris to say this is going to happen. What we say is it's now in a very high probability, depending on the type of signal. It's a high or a very high probability that a turn is imminent. But the market then has to do something to tell us that what our assumptions about the market are and the signals, it has to tell us that we're right. So if all of these signals that I create, they're all conditional signals, and they're conditional on going to the point at which they're elected, which is almost always a true high or a true low on a chart. And in this case, if you look at the our chart navigator program, we've got the exact number that this market would have to go to elect this blue line signal. And here we are. It's called our trade program. Yeah. Too many trade words, haven't we? Got trade navigator, trade program, too many of them. Anyway, I've skipped a chart there. Think about this. You don't have to blindly run in. The market would need to go and take out that high. The exact number is in the trade program. Click on that, and it will tell you exactly where the entry point is if it is elected and where the initial stop goes. But this is almost identical. This pattern on the S&P is almost identical to the pattern we had 2 weeks ago, and it happens quite often. There's a very strong seasonal bias in weekly charts. Thursday is the best day to sell. I'm talking about the equities now. Friday is the best day to buy. And very often you'll get a little move down on the Thursday and a rally back on the Friday. The seasonality of Friday being up days is absolutely extraordinary. It's enormous. It's like the market wants to make sure you enjoy your weekend. We'll give you a half-decent bar on Friday, but just watch what happens. That's two weeks ago, our last webinar, we talked about something very, very similar to this pattern on the S&P. A bit of a sell-off on Thursday. Last week's was better. This week's fairly muted, wasn't it? But anyway, we got a sell-off, and Friday we'll have a buy bias, a seasonal buy bias on it, and we've got those signals in the Russell and the Dow. Excuse me, for tomorrow. Okay, gold went through a long consolidation there, didn't it? It was just banging around, going nowhere. All of a sudden, we've had a little bit of a breakout where we had our TO3 plus buy signal, and it started to move quite nicely. In fact, on our 6S program today, we've got gold closed today on this trade at plus $3,400. Pretty nice stuff because it's been dormant for a long time. This is sugar, folks, and I wanted to run through something with you that may have confused you. Let me bring up a chart here on sugar. And you can see we had a TO3 buy signal after the close on Tuesday. So we bought that and got long on Wednesday and had this nasty little gap up, trade down all day. It looked quite horrible, and that certainly panicked a lot of people, and they shorted on the close. A lot of MOC shorts in that market. But talking about trades have to be elected to mean anything in the Daniel Code lexicon. there was at the low on Wednesday, that low was 1684. Now then we got an outside bar, so you would assume that that low was taken out. In fact, it wasn't, because we always use a 2-tick buffer, and that low needed to in fact go to 1682 to get a short, and it didn't, and we're still long in sugar. It only went down 1 tick. Have a look at those 2 bars, extraordinary, isn't it? The gap up trade down day put in a low of 1684. The outside bar put in a low of 1683, 1 tick below the true low of the previous bar. So that's why I use the 2-tick buffer. That can get trashed as well, but generally there's enough of these 1-tick. They're essentially a fat finger, or they're day traders just pushing through the obvious stops. But that's why we use a 2-tick buffer to avoid nasty little scenes like this. Okay, so let's move on. That was sugar. US T-bonds, very interesting. We had a TO3 and a blue line sell right at that high. See how accurate that is. That's a high. See if I can bring that up here for you and show you that high where it says TO3 and blue line sell. That high was at 164 carat 30. That little arrowhead is called a carat, and it's a hangover from the more old-fashioned method of quoting prices that was adopted by CBOT, Chicago Board of Trade, which used to be the other major exchange when the CME, Chicago Mercantile Exchange, and CBOT were separate exchanges. And they then merged. This is probably 4, 5, 6 years ago now, even more. But the CBOT traders were adamant they didn't want to change their methodology. And you can see all grains are quoted in these correct setups. In fact, on T-bonds, it has 32 ticks in a point, so 32 numbers under the correct arrowhead to make 1 point, which is 4 times 8. If you want to know why the rule of 8 rules all markets, well, it rules parts of them. But the Daniel Code, which picks out numbers very similar to the rule of 8 in 3 areas, it controls all markets. So that high came absolutely at the number. Have a look at this little the low down. We've got 3 days down. The low was 161 carat 6. Where's the Daniel Code number? 161 carat 5, twice. 1 tick variance. And those retracements are running from the swing high. They've been there for 3 or 4 days. Amazing, isn't it? And what about today's high? Not far off. The high is 164 carat 0. Where's the Daniel Code number? 163.31. The next tick makes it 164 carat 0. 1 tick away. Tick, tick, 1 tick. Marvelous stuff. Members charts, folks, you should make sure you look at them as soon as they're updated and pay attention. This is T-bonds. There's a lot of drama going on about T-bonds. A lot of the T-bond traders were hurt in this push down from the 89 cycle. This is the long-term trend chart, folks. Each of these bars, 24 days. You've seen this on and on and on. I just keep showing it to you regularly. And I think I told you some month or maybe more ago that the T-bonds was trying to hold support at the extension of the Daniel Code angular line. It's the thicker red line running through the market. That's the median or the mean of the Daniel Code trading channel. The dotted line below it is 1 standard deviation below the mean. The low is 2 standard deviations below the mean. And that 2 standard deviations, now they're not mathematical standard deviations, they're Daniel Code ratios of 1, then 2 days above, 2 days below. And I'm talking about time, because time and price are the same thing on different axes. And you can see how it spent 1, 2, 3, good 4 months trying to rally around that support there. I told you about it 2 months ago. That's about right. And it succeeded pretty much and started to move up. So this long-term chart, always be aware of the long-term implications. 6S, those of you following it, coffee's trading particularly well at the moment. We're plus 1950 at the close today. Russell, we're plus 33.40. That's still negative there. I'll have to click that, put a minus in front of it for one contract. We're plus 33.40 into today's close. And sugar. We had a nice ride down on sugar. We were short sugar, and then we've got long the last 2 days here. In fact, we got stopped out yesterday. We got long today. And have a look. This is here to show you that it's that 2-tick buffer that we use above true highs and true lows before we consider a trade elected. So that's why that's there. Wheat, Dean will be happy. Wheat's roaring. Up and up and up it goes. 2,500 at today's close in the 6S on wheat. So, what's in your head as we come back from our trip around the world? There's things going on in your head that are defeating your massive potential in trading. The first is bias. A very good trader I know, and he is really a very, very good trader, he can't sell grain. He can't sell anything. He trades grain a lot and he grows grain. He's a farmer. He just can't bring himself to take a short in any of the grains because that's his bias. That's his business as well. His business is growing the stuff. And his mind needs to assume it's always in a growth cycle, a price going up cycle. But I mean, he can short the S&P, he can short dollar index, he can short anything else. He can't short grains. That's bias. The next big thing going on in your head is assumption. We had another one of my traders telling me this week, and he's a lovely bloke, and he's potentially a gun trader once he gets his head away and just follows the program. But he said, I did the fourth seal cycles just as Frank does them. I said, you wouldn't know what Frank does, mate. He's been doing this for 10 years. You're guessing anyway. His guessing got him on the wrong chart, the wrong number, the wrong inference to draw from it. And he was so overconfident, he took that short at near the then high in the S&P that he thought was the Daniel Code time cycle, which is the fourth seal cycle. He thought he'd copied everything Frank had done, which he hadn't. Frank had been doing this non-stop for 10 years, folks. I taught him this stuff. He came to a tutorial in Taupo, New Zealand in 2011. And he's done nothing else since. He's a farmer. That's his real day job, but he's passionate about time and he's done so much work. He really, really understands the time cycle. But that particular client I was telling you about, he's a very good bloke. I like him a lot. Good bloke's about as high praise as you can get from an Australian or a Kiwi, isn't it, Rob? He's a good bloke that covers everything, but overconfident. And the opposite of that, of course, is risk averse. People can't let their trades run. They see a few dollars profit, they've got to grab it. Why is that? Try to think this way. When you put the trade on, you put your stop, you put initial protective stop in the right place. That's the risk you've taken on entry. If you don't ever move your stop, that'll be the biggest loss you have. And you're going to move your stop. When you learn how to trade, you'll know how to move your stop. But if it was a risk you were willing to accept on the day of entry, why isn't it a risk that you're willing to accept 2, 3, 4, 5, 6 days later? And think about that. If you've got these sort of issues, write to me. I'm happy to help you in any way I can. I know a lot of people who are good technical traders. They love trading, but the head gets in the way. So what is in your head? And most of us have something in our head, okay? And we can get that out of it for you by teaching you to trade properly, giving you the confidence to have absolute knowledge of trading price and trading time. we can show you shorter time frames as well. So if you want to join the elite folks and do a Daniel Code tutorial, please send me an email, jneedham@thedanielcode.com. I'll be happy to send you some printed material. And if you like, I'll be happy to speak with you on the phone about what is involved in it and what you can expect. So remember, folks, the business of trading is the business of making money. And if you haven't already, you're most welcome to have a free trial of the Daniel Code. Go to www.thedanielcode.com. Just hit the register button. Any issues, contact Terry at support@thedanielcode.com. If you previously had a free trial, the computer will remember that and probably won't allow you access. But if you haven't had a free trial recently, you're most welcome to have another one anyway. Any technical problems, Terry at support@thedanielcode.com. And that's us for today, folks. Norbert, yeah, I'm one of them. We better talk again soon, mate. We talk again soon. This is our disclaimer, and I ask you, I beg you, I implore you to take this really seriously. It's really easy to lose money trading. I have to tell you, it's just as easy making money trading, but you have to know how to trade the Daniel Code before you can graduate to that level. But if you're not absolutely confident that you're a competent trader, don't risk real money. The interesting thing with folks who do tutorials, I ask them to do quite a lot of paper trading afterwards, and some people, they just won't do it. They don't want to do paper trading. Well, it's their money, do what you like. But I have to tell you, the people who do the most paper trading make the best traders, because they've seen anything that can happen and everything that can happen without losing money. Their knowledge is enhanced. But that's us for today, folks. The weekend's coming up. I hope you have a wonderful weekend, and I look forward to seeing you at our next webinar. So what have we got here? Yeah. That's Jim, yeah, in the S&B, still under an elect sell. Should be, Jim, yeah. Benjamin, is it on a sell? Yeah, new sell for today. Anyone betting on Morrison with slow rollout, very slow in New Zealand? Boy, it's been an absolute disaster over here, Rob. There's just just not enough vaccine available. It's been very slow, and there's a lot of resentment or inhibitions about the AstraZeneca one, so they're all waiting for Pfizer. We don't have it. And I've already had my shots. I've had 2 of the AstraZeneca. And is that as good as the Pfizer? Well, better than nothing, isn't it? It's total disaster here too, Rob. Yeah, I gather that. Well, we'll see. Government, hey? I'm from the government and I'm here to help. Ronald Reagan said they were the most scary words in the English language. I think he was right. Anyway, thanks for being with us, folks. Look forward to seeing you at our next webinar. Any questions, shoot me an email. If there's something you want me to look at, a market you'd like me to look at particularly, if you shoot me an email, give me a few days to prepare it. I'll be happy to talk about it at our next webinar, I should say. All the best for now, and thank you for being with me. Bye-bye. Thanks, Rolf. Look after yourself, mate. Thank you, Rob. Take care, mate.